Hi guys, in today's video I am going to discuss about a new asset which gives you all the advantages of mutual funds and also saves you from all the disadvantages associated to it. Yes, I am talking about ETFs, exchange traded funds. Wait, only the name sounds jazzy, but this is one of the most cost effective instruments to invest in. So in today's video, I am going to discuss about ETFs, advantages and disadvantages of ETFs, concept of ETFs, etc. But before that, if you have not subscribed to my channel yet, please go and subscribe it and also press the bell icon so that you can get timely update of all my upcoming videos. So let's begin with understanding what is ETF. According to AMFI, ETFs are investment products which tracks the basket of stocks, index, commodities or bonds. It can be bought or sold like regular stocks on stock exchange. ETFs can be seen as mutual funds that can be bought or sold throughout the trading day. It provides the trading flexibility like regular stock trading, like short selling, limit order, stop loss order, hedging, options, etc. It also provides more flexibility features which are not there in traditional mutual funds and index funds. ETFs can track many assets like stock, bond, currencies, future contracts and commodities like gold. The thing to note here is like how mutual funds provide underlying security proportionate ownership rights to its investors. In ETFs, there is no proportionate ownership rights provided. The aim of ETF is to provide the same risk-return profile associated with underlying security and investment strategies. ETFs are mostly used for passive management. The purpose of ETF is to match particular index market and strategy, which will lead you to a fund management style which is known as passive management. To keep its fund parallel to underlying index, ETFs only do periodic adjustments. Whereas actively managed fund goal is to outperform the underlying benchmark, because of which there is an advantage of charging less fees in passively managed fund if compared with actively managed funds. According to AMFI, the TER total expense ratio of passively managed fund is 0.2%, whereas in actively managed fund it is 1%, which is a big cost difference when it comes to the end user. Now let's discuss how does these ETFs works. So ETFs focuses on replicating underlying index composition performance. They try to become the market and not beat the market. ETFs track the underlying index closely. In ETFs, unit creation mechanism ensures that there is a minimal difference in comparison with underlying index ETF price along with return profile. So ETFs provide the cost-effective way to the investors from market and index returns. For example, let's say an investor desire to make returns similar to Nifty 50. The best effective and simple way to achieve it is to invest into ETFs which are tracking Nifty 50. It is very convenient and cost-effective to invest into ETF, as TER total expense ratio associated with passive ETF is much lesser than mutual funds. Also, it can be bought anytime and in any format during market hours, like with limit orders at specific levels, whereas mutual funds can only be bought at given NAV, and the transaction of mutual funds can only be placed after market hours. Also, ETFs provide flexibility of short sellings to the investors, by which the investor can get opportunity of benefiting the adverse movement of underlying index. For example, if an investor is trying to take a benefit of fall in Nifty 50, for him the easiest and the safe way is to short selling of Nifty 50 ETF rather than sorting all stocks of Nifty 50 and Nifty derivatives. Here the point to note is that an ETF maker charges many type of expenses, because of which there is a difference in amount of ETF and underlying, which is known as tracking error. And where there is a minimum tracking error in ETF, that is the closest of underlying index, and so it provides the closest return to the index. Now let's discuss different types of ETFs. There are many types of ETFs present in the market. Number 1, sector-based ETFs which cover the specific industry sector like auto, IT, etc. Number 2, market cap weighted funds which covers the benchmark index like Sensex, Nifty 50, etc. Number 3, equally weighted funds which covers indices with equal weight given to all constituents. Number 4, debt ETFs which covers the debt market security exposures. Example, government securities, PSUs, etc. Number 5, gold ETF which covers the spot price of gold. And number 6, smart beta ETF. It operates with rule-based investings like dividend yield, momentum investing, etc. Now let's discuss the advantages of ETF. It provides a wide variety of asset type and investment strategy exposure to the investors which is not provided by traditional mutual funds. Expense ratio of ETFs is much lesser if compared to mutual funds, and also it provides better trading flexibility. ETF holders need not to bear capital gain tax, so it is more tax efficient when compared to mutual funds. If compared to mutual funds, ETF's structure is more transparent and it provides daily disclosure requirements too. And unlike stocks and mutual funds, the dividend earned by ETFs are immediately reinvested in the funds. Now let's discuss some disadvantages also associated to ETFs. So not always there is a less fees charged to ETFs. In actively managed strategies ETFs, the fees charged is equivalent to actively managed mutual fund fees. Like stock price, it has high intraday volatility as well. There is a tracking error associated to it, which means there will always be a lag with actual index or basket. Because of its user financial derivatives, its risk profile is higher than underlying index. And liquidity could be a concern if there is a less participation of investors. And now the most important part, the factors you should consider before investing in ETFs. So there are 4 basic parameters to it. Number 1, tracking error. The lesser the tracking error, the better efficiently the underlying index will be replicated. Number 2, liquidity. The higher the liquidity of the fund, the easier it will be to trade that ETF. Number 3, TER, total expense ratio. Of course, the lesser the better. And in the end, the 4th is AUM. The higher the AUM, the better it will be. So that is all for today. If you have liked this video, please don't forget to hit the like button and also share this with your friends. Also, please do comment below with your feedbacks about this video and about this channel. Your feedbacks are highly valuable to us.